Good morning, everybody. Welcome to the Flow Show. A new week begins. Morning, Dale. How you doing, mate?
Good morning. I'm very well. How are you?
Yeah, all good, all good. Bit of a hectic weekend. How about you?
Well, do you want to know?
Go on then.
We were at the beach and the usual stuff. So yeah, all good. All very nice. And plus, we are leaving for holidays in 3 days.
Oh, very nice, very nice. Even
Yes.
more peaches. Yeah, good stuff. Good stuff.
Yeah.
Yeah, bit of a busy one for me. I had Iron Maiden on Friday, which was really good.
Awesome.
Was,
Awesome. Was it as good as you expected?
yeah, it was. It was. I don't remember ever seeing them. I think this is one of those bands where I've seen pretty much all the big bands, but this was one, when you just never get the right moment or chance to see them.
Yeah.
So yeah, I had nothing to compare them to, but yeah, they were pretty good. Managed to flag
Nice.
it VIP box and get some free beer. So that was good fun.
Oh, well done. Well done.
Yeah, and then we had a festival, local festival, like tribute band festival down here on Saturday. So more of the same. And it had a really wicked AC/DC tribute. They were
Awesome.
unbelievable, amazing. So yeah, heavy weekend for
Cool.
me. And I
Nice.
think you got any spare places on your holiday Thursday? I think I need a break.
By the way, I'm not going away for a whole month, Mike. No, just 8 days. So I'll be back.
You'll feel like a month for us. Anyway, let's crack on and get stuck into it. Lots to talk about today. China, the meeting with Yellen, and according to her, the US and China talks have taken a step forward in relations. She said the talks were direct, substantive, and productive, and said both sides had learned more about each other. But she did say that the US and China still had significant disagreements and that no one visit will solve our challenges overnight. But this trip will help build a resilient and productive channel of communication with China's new economic team. So all sounding good on the surface, but reading through all the details, it sounds like there's a lot of, as we call it, empty platitudes there. They're still going on with various measures to curb chips, to curb chip ingredients, if you want to call them that, or components. The US is still looking at the practices of China and what they're doing that disadvantages US companies. So while it all sounds nice at the higher political tables, there's no change to what's going on underneath the table. And I think that's the thing that the market is concerned with, mainly on itself. Now, we did also have the fixing as usual. Keep an eye on that. It was fixed at 7.1926, so we're still fixing around that 7.2 zone, slightly under the 7.21 something that was estimated. Dollar China, it did last week have the move up to 727s. So we had a bounce up on Thursday. I was watching this. We didn't quite get to the highs. That's now given me a bit of an indication that maybe we found a bit more of a top up here. So far, we haven't seen a big collapse coming in. It hasn't followed the dollar like dollar yen as much as a pullback. So it's still keeping this keeping its bid. So we're still a bit undecided what we're going to do, but potentially a bit of a range setting up between 722s and these highs 727, 728. Now, one of the reasons why we might not be seeing a big collapse is because we know they're easing, and that's not going to change anytime soon because China's CPI came in year on year at 0, flat, versus an estimate of rising 0.2%. PPI came in minus 5.4 versus minus 5% expected and a prior minus 4.6. So inflationary numbers in China not looking too hot, and certainly no reason for them not to, or for them to discontinue their easing phase. Coming over to the Bank of Japan and their BOJ assessments, regional assessment, upgraded the assessment of 3 out of the 9 regions, leaving 6 unchanged. Said all regions saw an economic pickup or moderate recovery. Many regions saw tightness in labour conditions intensifying. There was also what's called the Osaka Branch Manager Report, which is run by the BOJ. Take a survey of all the regional areas and branches. And they said many regional areas of Japan saw small and mid-sized firms aggressively raise wages, reflecting intensifying labour shortages. However, they said it's too early to judge whether wage hikes will be sustained due to uncertainty over the economic outlook. Speaking on FX, many firms in region want FX to move stably. And they also said that many big firms, which are predominantly export-driven firms in Western Japan, do not see a weak yen as something negative at this stage. There has been quite some talk that there's not much problem on the ground level regarding the weakness in the yen. That's something that the MOF BOJ will take into account when looking at rate moves and deciding if they need to step in. If the firms and the public are finding it a problem, that ups the ante for when they might step in. Riksbank Janssen said we should be prepared for much larger hikes if necessary. That comment came out of the minutes of the last Riksbank's meeting. Over to the BOE, and BOE's man on Friday said it believes it would be better to front load rate policy moves, and she's seeing some evidence of persistence in inflation. BOE rate hike expectations continue to climb as we've been monitoring all last week. Goldies now see a 25 pip rate hike in November, and they've hiked their terminal rate now to 6% versus 5.75 previously. So rate moves still increasing in the UK. We've been talking about this continually, Stel. There's got to be a point where the market's going to get too extreme with these, isn't it?
Yes. The problem is, I think that we are now probably pricing, what we're pricing is probably fair for the Bank of England. It is, it's definitely more than the Fed and all that. But then again, inflation and average earnings growth in the UK are higher, and they're very, very sticky. We are expecting US CPI this week to have a low three handle, and we are what? 7-8% in UK. What is it? I can't remember the number, but it's absolutely
7.9.
Yeah, there you go. So it's still high. So this is theoretically what the Bank of England has to do to kill the economy and bring inflation down, which is what they want to do. I mean, do I think the market is going ahead of itself? I think we're probably fair now at fair levels. If it starts going further, I think it's something that we need to be probably fading. And remember, I've said for weeks now, I think that the pound is going to be probably the major currency that outperforms for the rest of the year, or at least in the short term, the next few months, because of central bank policy divergence. But if we get to the point where we're pricing too much, which I think we are slowly getting there, I think we are, as I said before, I think we're probably fair pricing of what's expected from Bank of England. But if we start doing more or pricing more, I think then it starts to become a case of trying to fade this. But for now, I think it's it was kind of expected. What the market pricing, how it's been moving, but from here on, it's trickier to call. I think it's a lot harder to call from here on.
Yeah, no, I'm in agreement. I think if we see any more extreme moves in the quid, I'm going to start getting the other side of it.
Yes,
maybe cable up at 130 will look very juicy, and
I agree.
Definitely a decent dip in euro sterling.
Yeah, I was just going to say that we have to be. We move with the markets, right? As things change, our views change. And remember, I've been saying, I'm bullish the pound, and it's been doing well. There will come a time, probably not too far from here, where I'm going to turn bearish the pound, but not just yet.
Yeah, timing is everything. Timing is everything.
Yes.
A lot to say in trading. Moving on to the ECB, I will answer your questions in a moment, Mike. Just get all the headline stuff out of the way. ECB's De Guindos, continuing what he was going on about on Friday, says what happens to rates in September is an open question. We need clear indications that inflation will converge to the 2% target. Now we need to look at the data, obviously, because we had some big data out. I've even got my calendar up. Look at that. You've caught me off. Let me get my calendar up. Oh, dearie me. Not done at all this week so far today. Oh, well behind. Look at that. Come on. Work. There we go. Right. So, obviously, the big data on Friday was the NFPs. And didn't quite live up to the ADP expectations, where we got that big 597K number. Actually missed, which I think was the first miss we've had in 15
months. Yeah,
15 months. But, you know, no one's going to moan about a miss of 16K when the number is still very positive. So 209 came in. Last month got revised down slightly from 339 to 306K. The underlying numbers were positive. The unemployment rate dipped as expected to 3.6%. That was with the participation rate staying unchanged. Wages were pretty bullish, rising to 4.4%. So they were revised up as well, so really unchanged. But it was a jump. It was 4.3 that got revised. Was expected to fall back to 4.2%. So that keeps the inflation side of things going well. And overall, you could call that another solid jobs report. Not that you'd know it from what happened in the dollar later on in the afternoon. Again, got a real big knock on the head if you look at dollar yen and other pairs going up. Now, this was a bit of a surprise because yields climbed on the back of the data, had been bid during the week, and they continued to climb well into 4%, confounding quite a few of us on this side of the fence over why yields will be taken off, but not the dollar. I don't know really what's going on, why the dollar's getting sold off. I've heard some commentators saying, well, the market is now, you know, firmly in with two more hikes and there's not going to be any more. And so we're seeing a reaction. That would explain the dollar. That wouldn't necessarily explain yields, and unless the market is further buying into this higher for longer stuff, because what we saw all last week, pretty much after any good bit of data, was an initial jump in the buck, and then it got sold off. So something has definitely changed in the market, in my opinion. What did you make of the moves on Friday? Quite a big sell-off in dollar yen, but not hugely reflective in dollar pairs elsewhere.
Yeah, I think the yen had been overextended for a while and was definitely due for a correction. I will not treat the yen as kind of giving us indications about the dollar. I think the yen moves are just yen. But the dollar versus yields, that's a tricky one, like you said. And I don't personally understand it. You know, usually there's a good correlation between yields going higher and the dollar strengthening, and we didn't see that. So, you know, from what I've heard and I'm reading and talking to people, it looks like there was a big push of flows getting short bonds. So basically, everybody talking about yields being higher for longer, which I actually disagree with. And I was reading the CFTC report for speculative shorts, and I think large specs is at I don't think record highs in terms of how many are short, record short, but very close to record short. So if that happens, and all these spec accounts are short bonds, I mean, theoretically, we could see a big reversal the other way. So I'm cautious about the spike in yields. I does this week, and definitely what the Fed does. We're baked in for a 25, pretty much 90+% chance of that. But I want to see what they tell us for going forward. I am personally really surprised that the market took these employment numbers, the ADP employment numbers, basically, not the NFP, and just priced out so much more in terms of, oh, we're going to hike more and we're going to stay higher for longer and all that. So on the back of the ADP, which A, is a very volatile number, B, for me, is irrelevant. Because really what the relevant part of US data now is still inflation, because this is the reason why the Fed was tightening like crazy. It was not employment. And if you look at the details, we talked about it at length last week. If you look at the details, this is not a good employment number. I mean, yes, the headline number is good, but go down, dig deep into why people are taking more jobs and the quality of the jobs. And it does not look like an economy which is really firing on all cylinders and doing great. No, I think it has it's a picture of an economy which is struggling at the moment. I know it might not make a lot of sense to a lot of people saying, well, look, we have 500,000 jobs and you're saying it's struggling. Well, look at the quality and look at the details, and it's not the same as booms that we've seen in the past. We're definitely not in an economic boom. So will the Fed put more weight on employment or inflation? Well, I think it should be 90% weight on inflation and 10% weight on employment. So I didn't understand why we broke out in yields. We were talking about the yield structure being a bullish flag. We talked about it on F.A.C.E as well. And technically, it looked like something that could break out to the upside, and it has. The question now, though, is will it stick or will it be a false breakout? And man, if it's a false breakout, I think so many people are going to be offside on this, on bonds. So I don't know what to make of the discrepancy between yields and the dollar. I think it's a lot of flows that are causing yields to underperform, bonds to underperform, so yields to outperform. Wait and see for inflation. I don't know what to say.
Yeah, I mean, I didn't think bonds were getting into 4%. I said the only reason they'd get into 4% is if the US data started coming in really strong, and taking aside what we know about the jobs market and the quality of the numbers, that services number was hot last week. Everywhere else had seen a big pullback in services. Manufacturing, we know all around, even in the US, is not doing well, but services, which is now the bigger sector in the economies, was doing really well. So the data in the US is coming up trumps, and that was my reason why bond US yields will rally. But it's been a rally across the board. It's not limited to the US. Look at UK 10-year yields sailing up towards the highs. Everywhere you look, yields are still up on their highs. So it's not just a US thing. So one question for me is, if people are short in bonds, where are they putting the money? Are they putting it in stocks because stocks remain elevated, or is this just the market saying, well, these decent numbers mean that QT is going to continue by central banks? Who wants to be long bonds when you've got central banks offloading trillions on their balance sheets? Is that a reason why yields are higher still, because the central banks are still QTing?
Probably, and I think the reason is that markets have been pricing cuts for the US for I think going out the curve everywhere, and that is something that's going to be taken out and is being taken out. So as long as all these cuts in 2024 or 2025 or whatever get taken out, well, yields are going to be moving higher. Yes, 10 years is a lot longer than the next 2 years, but it is a part of, if short-term yields are going up, it's only natural that the whole yield curve follows to a lesser degree, but it does. So I don't know. I actually don't think that central banks are going to be able to continue with QT and definitely not hiking for a lot longer. But who knows what happens in 3 to 6 months from now? Nobody knows. So it's difficult to predict. But I think combination of all this, the factors we talked about have brought yields higher. The big question remains: we are still very close to the breakout point, especially in 10-year US. We're about 15 base points away. They can do that in a day. If we come back in and cause a false breakout, then all bets are off. I don't know. I fear we're going to have another disappointing CPI print. And look at the Chinese numbers. You talked about it before. PPI big negative, and CPI 0% year on year. And just on mathematics, the way it's calculated, it makes sense that CPI is going to come back down, all else being unchanged, all else being equal. So I think the US CPI is going to continue to underperform and surprise to the downside. Will it get to target to 2%? Probably not, but I think it's going to get close. It's going to get close. And if it does get close, then the Fed will easily be able to say, look, the economy, some of the aspects of the economy are doing well, some are not. And maybe we pause completely and see what happens.
Yeah, definitely. No, I think I agree with that. Yeah. Right, well, moving on. As Dale mentioned, rate hike odds in the US remain elevated. We are today probabilities of an 89% chance for a 25 pip hike versus unchanged 11. That did mooch up to around 91, 92% after the data on Friday. It's dropped back a bit, but still looks pretty much nailed on for a July hike. Fed's Goolsbee was out saying that you can never make too much out of any 1 month of jobs numbers. Saying it's clear the jobs market is strong but cooling. We're nearing a more sustainable pace of job gains. He also cautioned against taking wage data as a leading indicator of inflation. He said prices move first and then wages move, which he's got a fair point of that. But what we're seeing at the moment is stickiness in wages around that 4.5% mark. If inflation comes down, that's going to mean real wages are in the positive, which in itself can bring inflation with it. He says we can have 1 or 2 more rate hikes this year, but he's undecided on what the Fed should do on rates in July. Coming back to the data, and Canada as well had a gangbusters jobs report as well. The employment change was up, called it 60k versus 20k expected, and a prior minus 17.3. On the magic roundabout, full-time employment huge, 109, nearly 110,000 came into full-time employment from minus 32.7 previously. Part-time lost 50k versus a gain of 15 and a bit k last month. So very strong numbers there. Unemployment rate, it did rise 2 pips. Was expected to rise to 5.3%, rose to 5.4%, but we can probably pin a lot of that on this participation rate number going higher by 2 pips. That means more people came into the market. Now, we do have the Bank of Canada this week, and it's another coin toss central bank, I think, for this one. They came off their pause with a hike at the last meeting. They cited higher inflation, a jump in inflation for the reason, part of the reason for their hike last time, as well as a strong jobs market, tight jobs market, and housing was picking up. Out of that, the only thing that's really changed is inflation. It went from 4.4 to 3.4, so it dropped a whole 100 pips since the last meeting. That might push them towards a pause on Wednesday, but I certainly think it's another coin toss for them on Wednesday. It is also a monetary policy report type meeting, so we're going to get a presser and all sorts of stuff going on there. So it's going to be one we'll be watching telly on Wednesday for that one. CIBC sees the BOC raising rates by 25 pips next week just on the jobs report. So they're going a bit hawkish for them. The rate probabilities currently stand at 67% chance of a 25 pip hike and 33% of keeping things unchanged. Right, just looking ahead this week, as is often the case, it can be a bit of a quiet week after NFP week, but there are some numbers to keep an eye on. UK jobs report is going to be a fairly big one for the pound tomorrow, particularly those wages numbers, to see if we're getting some of those strike and pay disputes coming through still in the jobs numbers there. Keep an eye on the Zoo survey as well on Tuesday. A bit of PPI data from Japan on Wednesday, as well as the RBNZ, and obviously that big CPI data. Now the CPI numbers, early doors, expected to come down to 3.1% from 4% at the moment, and that all important core numbers expected to come down to 5% from 5.3%. So inflation expected to pull back quite significant in the headline number, but a little less so in the core. Obviously, we'll touch on these numbers closer to the time, but that's the big data this week anyway. And then as mentioned, the BOC after that later on. Coming over to Thursday, we got UK GDP numbers. This is the monthly number, so a little bit of an idea there. These CPI numbers are final numbers coming in. ECB minutes, I'm not sure they're going to throw up anything untowards in the amount of ECB heads we heard literally the day after. I think we heard from all but 5 of them in the day after the last ECB meeting, so it's not going to be too much of a surprise what's in there. CPI follows up with PPI, which again, this has the possibility of throwing up a little curveball. It's PPI I'm more expecting to come down, more chance of coming down than CPI numbers. CPI numbers can be a little bit more funky, but PPI, that's the one that's showing all the input for goods and materials and stuff. So that could counter anything that comes from CPI. If we get a hot CPI number there, i.e. inflation not falling as much as expected or even going up, but if we see a negative year-on-year numbers in the PPI, that's going to suggest that there is some disinflation coming through the pipe, and we have to watch the lag between when PPI stuff impacts CPI stuff. So don't all get too in-depth into trading what happens in the CPI, because some of that could be undone with the PPI the day after. Friday, not too much going on. Michigan sentiment, I think that's probably I don't know if that's the flash or the final, can't remember. So much data passes by, I lose track of it all. But that's probably the biggest data we might get on Friday. Other than that, a fairly quiet week, apart from those 2 central banks. Right, so let's have a quick look at what's been going on in markets. Mike had a couple of questions. Is dollar yen a buy on a dip below 142 before CPI on Wednesday? Well, it was a buy on a dip yesterday, or rather last night, and coming in, because that's where we got down to on late on Friday. That's where we sat around. That's where we opened on Sunday, and then we had a bounce up to 143. For me, is it a dip buy now? I don't know, Mike. It's the levels have shown up. If we take it out a little bit, I had this old level here, which was part of the break move up, which goes back a bit further around that 142.2025. We went through that, held the big figure, but now we're holding that on after the bounce to 143. I still think the close below 143.50 is important. That takes some of the heat off up here now. We're setting new lower bounds. So this, to me, is the pivot line now. If we can't get above there, it's going to make it very hard to get back up here. We have had a bit of a steep pullback, though, from that bounce this morning to 143. So it really is an open book what happens here. Would I buy 142 before CPI? Depends when it happens. If it happens today and we hold, then yeah, maybe you've got a trade on your hands, but I'd be quick to take profits if you do see another rally. I'm not comforted by the fact we had this near 100 pip bounce, but it's come back so quickly. That doesn't smell good to me. So I'd be very careful on another move to 142. If you're going to try catch the knife there, then don't put too much money on the table and keep it fairly tight, because if we break there, we could be heading down to the mid to low 141s pretty quickly. Yeah, we've had this conversation. I don't think the pound will weaken too much until we see signs. But what I think will happen is it's the old case. It's like when you're fighting bullies, the bigger they are, the harder they fall. The more the pound goes up on increased rate expectations, the higher those rates actually go from the Bank of England. I think the harder the pain's going to be further on down the line, and the harder the pound's going to fall after, and the faster the rates are going to have to come back down again. So yeah, much as we've been just talking about, I think the pound remains fairly decently bid. I'd like to see a bit more downside in euro sterling. That to me, not moving too much, says that the cable move is more on what the dollar's doing than what the pound's doing. But yeah, if we get a decent move, as I said, I'm looking to start getting into some shorts if we start hitting some extreme levels. I really had the itch last week. I've still got the itch. I'm just not ready to pull the trigger just yet. And on Japanese funds, I don't know what the funds are doing, positioning for a YCC change. They don't. The market's got some pretty low expectations for what the BOJ is going to do in July. It got itself a little bit expectant for June, but then that was quashed by UEDA and some other bods. We've had the same sort of thing for July, which we can't rule out a surprise, but the BOJ don't like to surprise too much. So I don't think there's anything that brings a change in policy at the July meeting. What we may need to be over is this, whatever was going on with the ETF selling for the dividend payments we were talking about last week. The last day supposedly was today, so maybe that's cleaned out whatever was going on. But for now, the price action, just look at the levels. As I said, 143.5 is the number now on the top side, and we've potentially got something down here at the 142s. Could just be a simple case. You go whichever side breaks first and run it that way. Let's see what else we got going on. When workers on strike in the UK, are they counted as unemployed? No, they're still employed. Yeah, that's no change in that as well, because they're just striking over pay. It's unions, rules and regulations. So yeah, if you're on strike, you're not unemployed, because they only usually go on strike for a couple of days. So you're not going to go unemployed for a couple of days. It's not, the strikes over here are not ongoing, i.e., go on strike day one and it's now day 46 of strikes. The train drivers, they'll strike for 3 days here, 2 days there, a couple of times a month maybe. Same with teachers. We had strikes Wednesday and Friday last week in the schools. There may not be another one for another month. So it's not walkouts when no one is doing anything for days and days on end. So no one gets unemployed in that sense. Looking at euro dollar, and not quite getting up to that 110 area in this move. It's still looking a bit laggard. I'm really not sure where this one wants to go. It can't break down, it can't break up. So for me, it's just about trading the ranges, getting a sniper rifle out. I might be happy to look at anywhere above 110 up to 111 as a decent potential scalping opportunity. Just fade the levels, and the downside, we couldn't get down to the 108s, which has been the big level. That 108.30 in my magic zone showing up again, and here we are afterwards on Friday, the top end of the zone holding up. It's amazing sometimes how the techs work, don't you think, Dale? You put some coloured lines on a chart and you find it gets respected.
It is amazing, and they work for so many different asset classes as well. I've said for a while, I was really surprised to see Bitcoin trading in a really nice technical way for ages. So it just shows you the technicals, they're based on psychology, right? On human psychology. If enough people are looking at something, then techs usually work. I mean, not always, obviously, but usually they do. So yeah, I agree with you.
I don't know how many people's looking at my my magic zone, but there must be a few now. So it works. It works. That's the main thing.
I don't want to look at your zone, mate. Seriously, I don't.
Oh yeah, we'll save that for after the show. Right. So on the CAD, this one was confuddling me as well last week. It was shooting higher, even while there was no real reason why it was going higher. The dollar was coming off elsewhere, and this one was going up, even as oil was rising. Oil's had, we call it a little bit of a semi-breakout, let's call it that. It's still looking up, and obviously the jobs data on Friday has done a lot of work here now, and maybe the oil influence is starting to have a bit of a say. Couldn't quite get up to that 134s, which is a previous historical pivot area where we've had support and resistance. If you got into a short up near the top though, nicely played. Some good pips on the table there. Obviously with Bank of Canada this week, we're probably going to find ourselves going a bit sideways. And the market, as I said, in a bit of a coin flip mode as to what the Bank of Canada are going to do. If they pause, we could well be heading back up to 134, and maybe we even break it, that area. So this is one where you may get an opportunity if you look at what's happening in the dollar elsewhere, because obviously the dollar is always usually the more dominant currency. So if the loonie moves out of sync with what the rest of the dollar space is doing, if you like, that might be worth a fade. So if dollar's looking weak across the board and we get a decent pop here in dollar CAD, then maybe there's a bit of a fade on the table, especially if oil is remaining bid. And as you can see there, we got above another of my magic zones around the 72, 73 area. So no signs of this move off the lows halting just yet. Whether we can get high enough to challenge some of the decent topside levels, around about the 80 and a half, 82.50 is obviously a big decent level up here as well. Got some work to do to have a crack up there. So yeah, dollar CAD could be an interesting one this week. If oil is still bid, as I say, and dollar is still weak, then the loonie is going to move, if it goes up, out of sync with that wider picture. So that's going to be one I'm going to be keeping an eye on for that. As mentioned, also euro sterling. Looks like 85.20s, 15.20 is the number at the moment for this pair down here. We've had a couple of looks down here, had a look last week. However, the bounces aren't looking overly strong at the moment. So got the potential for a short-term double bottom here, coming towards the end of June and now in July, but we need to see what this has to do. If it can't get really above this zone, I think we're still potentially heading lower. There's no signs of this bearish move that we've seen, going back to the beginning of the year, early this year, is stopping yet. But there is a bit more balance down here with this movement into 85.20 holding. So all to play for this one, I think. But I wouldn't be surprised to see a shove lower. I'm still interested in this area here, but the more times we test here, the more times we come back here, if we do get a break, it might clean out this area without much of a look. So I'll be less convinced in trying longs down here. Let's come out a bit wider. If it looks like the break could have some legs and give us a real kick through. Oh, what's going on with my charts? Come on. There we go. So yeah, I don't like a price that sits too long at a level, because it just means when you do get a break, it could be a bit blowy. And as we're 20 pips, the lows are 20 pips off the lows, then we could get a bigger, steeper move down to maybe this sort of mid 84s, even down to the big figure down there. So another one that's in the pipe to keep an eye on.
Ryan, 83 to 83 and a half is still my target for that, for euro pound. And that's, I think, is the point where the market will have started to price way too much from the Bank of England. And then we start reversing properly the other way. So yeah, 83 to 83 and a half is a pretty big zone that I've marked for ages. And yeah, that's my target for now. Yeah,
this is where I started getting long ages ago. I think you was on that bus as well. Yeah, and we got out I got out just before the spike up. It's a lovely one. When it plays the top end and bottom ends of the big ranges, it's a lovely one to play. And I'm right. I think I'd have the wheelbarrow out if we get down to 83s again.
Yeah, same here. Unless something's changed in the fundamentals, but I'm definitely going to look at that. I remember down at the 83s in 2022. We were talking about it. I got a little bit long. Unfortunately, I didn't catch the whole move, but it was a nice little trade. And Yeah, if we get there again, I think I'm going to have another go, and hopefully this time I'm going to hold it for longer.
Yeah.
Not,
Well, just let me know where you go bid, mate, so I can stick mine in front of yours.
yeah,
Like,
your pound is so it goes in flows, right? It goes in runs, in big runs. One big run from early 2022 up to the 90s, and then it kind of consolidated. And then now another run down towards the 83s, and another one coming, I think. So anyway, one step at a time.
yeah, it definitely requires a lot of patience, but it can
Yes.
give you good short-term trading against the ranges.
Yeah.
And then, if you're prepared to wait for your levels, like we say, get the edges of the range, then yeah, you can get in and you can sit in and make some decent pips on the back of it. But it does require a lot of patience. There's times you can sit in a short-term trade for weeks waiting for something to happen in this one. But sometimes those lower volatility pairs are good because you're not getting big flashy moves that knock you offside suddenly by 200 pips. It gives you time to adjust if you need to do so. That is the nature of trading. I'm going to take a quick look at the Kiwi, seeing as we've got the RBNZ tomorrow. Expectations for the RBNZ are that they keep rates unchanged. That's price still probability at 92.5% at the moment. So I wouldn't be surprised if the RBNZ pause. As far as the market is concerned, they almost indicated as much that they're much more into restrictive territory. So again, look for potential counter. If they give you something, as I said, dollar's looking weaker. If you give them something that sends the Kiwi lower, obviously that will make the dollar stronger. That's maybe where you want to look to fade. But trading into these banks is I don't know, you're taking a bit of a risk, and so it's better to look for an out-year move on an announcement to get in a trade and try and take it the other way. Still, you got anything in particular you want to look at this morning? Just any? Oh, we'll have a look at gold, I think, quickly. So, gold. We're knocking the head up in this 1933.
By the
area.
way, I was muted and I was saying stuff, but nothing of importance. I don't. Yeah, no, I don't have much to show today. I was just thinking, it's talking about gold, 1895 to 1935 or so, like the short-term range. Yeah.
Yeah, I was looking at this one last week. I took a long in gold at 1905 because I thought we had this breakdown. Looked like a typical clear out the stops and then a bounce. So I tried again when we came back down again to the 1900s. Where was I? Did it in here and got in at 05s, 06s, knocks them out. And typically I had a TP on the whole lot on Friday while I was out at 1935, and we got up to, what did we get up to? I think 1930. So yeah, typical, back waiting for that one. Probably my fault for sticking my TP right on the line, but I thought 1935 and a half was more the number. But anyway, such is life. But I'm still long a little bit there. And I'll see what happens with this one. I've got my stop dragged up behind it, but again, it's just range playing. And as I said, we got this zone up here in the 30s, and we had the breakdown, and now we can't get back above. So something's going to give in this one. We're either going to break back above and move higher, or we're going to bust out through this 1900 level again, and then we're heading lower. So keep your trading simple, folks. You don't need a bias. You don't need an idea. You've got two levels. You trade them whichever way they go. Is Aussie a buy on a dip below 66? I don't know, Mike. Is it? You tell us while I pull up the chart. Certainly, we're finding support into there. But this looks a bit similar to Euro Sterling. We've got a bit of a double bottom forming over a couple of weeks, but the bounces are pretty limited. It's certainly a tight one, 66, 65, 90 is your level below. We can't get above 67. 67 is the new 68. So is it a dip below? Is it a buy dip below? For me, if it goes below, it's changing. Something's changing. So if you want to buy it below 66, where are you going to buy it below 66? You know, for me, it's going to be maybe down into here, 65, 60, 65 and a half. But I would think if we do break this now, then potentially we're heading lower. So you might want to set your sights maybe a bit lower. We've got this old zone here in the low 65s. There was a bit of an area previously last year. Not so much this year, though. We have had a few, you know, points and touches within it, but we did have a break through it last month. But it could be one of these ones where we've been away from it, we come back, it might show up again. You know, give us something, Mike. You know, you're talking about, is it a buy on a dip below 66? Well, where would you buy it if it dipped below 66, and why would you not buy it at 66 if that's currently confirming as a level? You know, you want it to break before you buy it. You're looking for a stop flush, then to get in. But the old saying counts: a level until it's not. So why not trade the level instead of waiting to trade it after it's broken to then become a level again? Anyway, yeah, just let us know. Same for everyone else in here in the chat function. If you've got something you want us to look at, you've got a question about a pair or anything to do with trading, throw it up. We're happy to discuss it. You know, don't want to hear just me and the lads waffling on about our thoughts about pairs. We want to hear what you've got to think about currencies and stuff. And as I said, you've got any ideas or questions, throw them up and we can talk about it. Yeah, looking at
By the way, we didn't talk about, I don't think we mentioned it. Did you mention Norway CPI this morning?
No, I didn't. Was there?
Yeah. Norway CPI beat expectations. It we expected to fall from 6.7 to 6.2 year on year. It fell to 6.4. Core CPI went up. So
yeah, 3 pips.
Interesting. Obviously, a big dependence on oil, and as oil price goes up, Norway has a much bigger effect, let's say, than other countries. But still, very interesting. You know, I think this is different to most of the major countries where we're seeing inflation gradually slow down to not target, but, you know, getting close to. But anyway, and we see the krona kind of doing well today on the back of that. Still relatively weak, though, you know, because the central bank keeps selling and selling and selling. But at some point, these lows are going to break 1140 something in Euro Norway, and when they do, I am going to be smashing into them. Or maybe, actually, no, maybe though not those lows. It's a trend line from the May lows and then the June lows. So those two bottoms there, yeah, that's the one. Yeah, that trend line there. You know, 1140 or wherever it comes to. There you go. Once that breaks, I think it's confirmation, and, you know, get a lower low. I think that's going to be a nice little short-term trade.
Yeah, I've still got my old Head and Shoulders on there. I've got it on there. I don't do Head and Shoulders, but I'm keeping this on here just to see if it plays out, and then I can claim what a great technical tool Head and Shoulders are. But yeah, I mean, we know they're hiking still. Where can they hike to, though? I don't know where they are. They're 4.5%, I think. Are they Norges? Maybe even, or did they touch 5%? I can't remember.
I can't remember either. Hold on.
They're still going and showing no signs of really stopping. Yeah, and that CPI data will
3 3/4. 3 3/4.
Oh, they got a bit of room.
Yeah,
to keep going then. But yeah, we wouldn't be surprised if we see their rates up at 5% sometime during the rest of this year, especially if you're getting inflation reports like that. But yeah, technically, you know, still pretty spot on. Got this trend line here. This fib is just from last year, so it's just this leg up. But in the wider picture, it's just been a humongous trend, as the guys have shown time and time before. You know, and a lot of it is due to the central bank. They're sort of their own worst enemy at the moment. You know, with their currency, what's going on with that. But technically, yeah, I mean, if you get another move up towards these highs, it certainly seems to be holding around these trend lines, and particularly this 1190 area again. So what would you do? Would you look for a break up and then sell into that, or a break of this prior high, or just are you getting a twitch to get back in this sort of area up above 1190s to 12s?
Oh, to sell on a rally, you mean?
Yeah.
I think it's a lot clearer to sell on a breakdown. But what would I wait for? I don't know, man. If it gets back up to the 85s, I think that's going to look bad for the krona. So I don't know where I would sell on a rally. It will depend on a lot of things. I think a lot simpler is the sell on a breakdown below 1140 or 38 or whatever that comes to.
Yeah, Gavin's got an area around 1148. Yeah, it does look a bit of a level there. Take a few shekels, as we like to say, on that one. Shekels. Yeah, that's one we don't trade a lot. Right. Well, anyway, that's I think that's been plenty this week so far.
Yeah, I'll take a look at some charts tomorrow. Okay.
Yeah, we'll split up the rest of this week. Yeah, Brown, we can have a look at Swiss in the room. Though it's one currency I'm not got a lot of interest in at the moment, considering the central banks on both sides of the trade on that one. But anyway, hopefully that's got you set up for the week ahead. We know the big events to come, the risk points to watch at, and the areas and levels you want to look to trade perhaps at them. We'll obviously look and stuff a bit more detail tomorrow. So thank you, Stelios, and thank you, boys and girls, for coming to the Flow Show, and we'll see you all tomorrow morning. Cheers all.
Thank you, Ryan. Thanks, everybody.